You're watching Stockwatch. I'm Simon Brown, and joining me to unpack your stock-related questions today, Victor Seanie from Benguela Global Fund Managers, Mutooni from Sanlam Investments. Be sure to send your questions through email stockwatch@bdtv.co.za, SMS 41392, or on Twitter at BusinessDayTV, #Stockwatch. Gents, appreciate the time. Let's start off with the I suppose, the big macro story. Roy, Moody's on Friday, I suppose, being moody, not upgrading us. The argument is that there's a downside risk to our GDP. And it would be hard to argue against that. And I suppose we did get S&P last month, so we'll take it. Your thoughts? I mean, I don't think they were necessarily massively wrong. It would have been a pleasant surprise, though.
Yeah, look, I think there tends to be a sequence in these revisions and upgrades regarding Fitch, Moody's, and S&P. But I think what Moody's were referring to was basically it's the last thing, and it's the hardest to get in place. So we've spoken about reform, getting on the list, lower interest rates, lower inflation. But all of those things put together don't seem to be kicking growth up to levels that you could actually call characteristic of an emerging market. And I guess in their minds, all of these things just allow you to keep your debt levels at certain points. You see, the big concern is that your debt, your gearing effectively is driven by how much debt you have, how much you're servicing, and how fast your GDP is growing. If your GDP is not growing, then you're constrained at that level. So I think it's the fair thing to do. We actually need to show we can grow above trend, and that our potential is not this 0.7, 0.8 that we keep on seeing, and is closer to 3 before we get closer to investment grade.
Victor, I mean, I take the point, and we had some GDP data out, and it was 4 quarters of growth, etc. But the bar was very, very low, to be clear. As much as we all loved the data, GDP perhaps is our Achilles heel.
Yeah, I do think so. It seems that government debt is set to grow at a faster rate than our GDP, therefore limiting government's ability to repay the debt. The consumer is still in a very difficult position, as you can see from the results from our retailers, as well as Total that came out this morning. So the biggest driver of GDP growth is still under pressure. And then in terms of investment spend, government's debt spending and social spending continues to crowd out some of its investment spending. And then on the business front, business confidence is still flagging.
Yeah, and we've seen lots of green shoots, but to be clear, they're baby little shoots. Victor, let's stay with you a moment. Friday saw the proposed deal, Netflix to buy out Warner Brothers, $72 billion. There's T's and C's. Some of it is cash, some of it is shares, some of it is spinning out assets they don't want. Your thoughts on the deal, and if it's going to get regulatory approval, which is perhaps going to be the harder part?
Yeah, I think this deal is going to be a fascinating deal to watch unfold over the next year or two. So many interests and so many implications coming from this deal. We know that Trump is friends with Larry Ellison, and Larry Ellison's son tried to buy Warner Brothers Discovery, and Trump has definitely has not minced his word about the extent of industry concentration that this will lead to. So it's going to be very interesting how regulators decide around this deal. Implications for what's happening locally, as we're all aware, MultiChoice is still in negotiations with Warner Brothers for those 12 channels, including CNN. I think if Netflix were to acquire WBD, that would be further negative for MultiChoice, given that Warner Brothers needed MultiChoice as a distribution channel into Africa, but Netflix wouldn't need them as a distribution channel that can just stream directly. So the negotiation will become much tougher for MultiChoice.
Roy, your thoughts on it? I mean, it almost, in a sense, leaves two big players, which would be Disney and Netflix. It also, I mean, I don't know. My mind keeps going back to time AOL 2,163 billion. And it's probably not fair, but I can't stop going back there every time I think. And your thoughts on the proposed transaction?
So these media deals are all premised on two things. You either have the distribution or you have the content. If you don't have the content, it costs a hell of a lot to build these things. And what Netflix are buying is this huge, incredibly valuable library that just gives them franchises that you can keep on spinning out and twisting and turning without the cost of actually creating the stuff yourself and the risk of failure as well. So from their perspective, they're never going to get another bundle of deals like this. And that's why they really want it. Like Victor said, there are clear competition concerns because it brings a lot of concentration. And you've seen that in Hollywood already. They're really scared that you have one big behemoth who controls the pricing for production. And Trump has already said he's against it. So it'll be interesting to see what the regulator says. But if Netflix gets it, watch for realignment in the rest of the world. The ability to distribute and to direct production, I think, will change the game wherever media is played.
Yeah, absolutely. I mean, it's going to have massive implications for everyone, as you both point out. Roy, Spar results today. Certainly, in a red day, the market seems to be liking it, although maybe this is more base effect than anything else. Your thoughts on the numbers out this morning?
I thought it was a weak result. Maybe the market is relieved that it wasn't as bad as they expected, but I think it was actually worse than I felt it was going to be. They're in a very difficult position. They're going through this whole restructuring. They're refocusing in SA at a time when you've got this big behemoth that is the Shoprite Group, and then Walmart's coming in. Who knows what they're going to take? Pick n Pay is also restructuring. And they've got their own inherent internal problems. I think one good thing is that the loyalty from the franchisees at least held up. So at least that just shows that there's a flaw to the bleed that they had there. But yeah, weak result. I think it's going to be tough for them to recover from here. I think market expectations are just going to keep on being downgraded from here on.
Victor, for you, the results coming out this morning from Spar?
Yeah, I agree with Roy. It was a weak result. In a market that's growing really slow, the key is excellent operational execution. And scale will always be key. However, we see that Spar continues to fall further behind in relative scale compared to the other players ahead of it. So it's a number 4 player now, if you would position it perhaps, far behind Shoprite, behind Woolworths in that part of the market, and also behind Boxer. Those players executing tremendously well. However, Spar is lagging behind with earnings, with sales growth that's 2 to 3 times below those players. So its relative position continues to weaken. Management is going to have to, I'll pull a rabbit out of the hat in order to improve the situation. Yeah. And you look at the loyalty, even though they say their loyalty with their retail in South Africa has been somewhat stable, it has gone backwards year on year. But it's positive. Balance sheet has improved.
Take your point. There is some positives there, but also it's a tough space. And I mean, you're fighting against Shoprite, which no one would enjoy. Let's touch on the Nampak numbers. It's down a little, but truthfully, the market really liked the update, which they gave us of a couple of weeks ago. I mean, Victor, this is a turnaround, which is kind of turning around.
Yeah, it's not a name I follow closely, but I think it's a name that's going to be perennially challenged. Given that its customers have such a large amount of bargaining power over it, if Nampak tries to raise costs, its customers just import cans, and if they need to, they can integrate backwards and really undercut Nampak's bargaining power. So I think it is really a poor quality company. Positive that the balance sheet has improved, positive that their cash flow has improved, however, not enough to pay a dividend. So this is a name that we'll probably avoid for a long time.
Roy, I was always taught that you bought packaging firms in booming GDP. To your point at the top of the show, we don't have the booming GDP. Your thoughts on Nampak?
So unlike Victor, I actually think there's potential in this one. Thing is, they've gone through this big restructuring, and the whole point of that big restructuring was to address some of the things that Victor was saying. That the fact is, when you're a manufacturing concern and you've got big customers and big suppliers, your cost base is always going to be your Achilles heel. So Phil Roos really crushed that cost base, and he went to the finest detailed, sold off businesses, and now what they're left with is a very strong beverages business, a diversified business, and Angola. So Angola is doing pretty well on the beverages side, whereas in SA, actually in both of them, what you're seeing is customers are moving towards aluminium packaging, and they're the big gorilla there. There are other competitors who are probably as good as them, but this move away from PET packaging to aluminium definitely plays well for them. You need capex, you need to keep on expanding capacity, you need to manage your costs. I think they're nicely placed. It's never going to be a business that earns a return well above cost of capital consistently, although it is doing that right now. I think for the industry as a whole, it's all about cost management, manufacturing efficiency, and just holding what margin you have relative to your suppliers and your customers. So I actually liked the result. I think the debt is well down, margins are up. There was a bit of a blip in the diversified business. Angola is doing really well, and margins generally went up.
Absa came out with a trading update earlier today. It was, with respect to Absa, completely and absolutely boring in many senses, but that's what we like from our banks in many ways. Market is liking it. Roy, for you, the Absa update?
Absa always has little issues here and there and restatements and stuff. This was the first time you didn't see that. Relatively clean, pretty good guidance going forward, mid-single digit growth expected, credit impairments not bad, a good strong performance from the Africa businesses, and an expectation to see some good growth out of those Africa businesses relative to SA. So it's actually living up to its promise. And I think with the new CEO coming in, you probably see a few other things happening over the next couple of years. So it's actually a result I liked. I think the market understands this is a cheap stock. Yeah. It's disappointed historically, and it's probably on a good trajectory from here on. So solid valuation, like you said, very predictable, very boring update, but that's exactly what you want from this stock at this point.
The stock is just off 52-week highs. It's had a good year, but it's always been the cheap banks. And frankly, our banks haven't had a bad year either. Your thoughts on the stock and the update?
Yeah, I think it was a good update. Probably the only exception would be the extent of revenue growth, only in the mid-single digits, compared to its competitor banks that are growing slightly faster than it is growing. But fortunately, it is benefiting from a reduction in its credit loss impairments far more than the rest of the banks, because unlike them, they had been incurring credit losses above their through the cycle range. So that is bailing them out during 2025, and that'll further support earnings growth in 2026 again. And then we'll see that they'll improve in their cost management in 2026. As opposed to in 2025, costs are growing slightly ahead of revenue. So pretty much good guidance given for 2 years, 2025 and 2026. So earnings growth looking good. It's positive that they've indicated to a high teens ROE target. I think they'll be challenged to achieve that. They've set out clearly how they plan to achieve that. Do have confidence in the new CEO to make sure we reach executions.
Yeah, no, I take your point, and it is. I mean, a lot of sea change happening at Absa, but a good sea change in a sense. A question came through around Shoprite. Victor, you were mentioning it a moment ago, tough to compete with. The question is, Shoprite's our best food retailer, but is it a good price in the low 270s? Is it offering value at current levels? We all love it as a retailer, but is it a good price, I suppose, is the question.
Yeah. I do think Shoprite offers good value. Just from the drivers, it's the scale leader. It is best in class execution. It is growing above the rest of the market, even though it is the largest player in the space. So all around, I would expect earnings to continue growing into the future. It may be at a lower rate than what we've seen in the past 2 years or so. And my last valuation for Shoprite was at about 330 range. So at these levels, it does look attractive.
For you, Roy, Shoprite?
Look, I think there's two ways you can look at this. So relative to recent peaks, it's well off. And it means, its long run PE I can see is about 18 times. It's probably trading at about a 17.5. So it's offering value. But I think you have to put this into context. I think we've factored in pretty much them dominating the markets, them having top of the cycle margins, really good margins through the cycle. But at this point in time, inflation is quite low. And retailers hate environments where you have deflation or very low inflation because they can't price up because your costs continue inflating. Salaries, logistics, and all of that continue to increase at inflation. And the inflation that they're getting on their prices is actually quite low. And I think that's what's compressing the price as it stands right now. So I think through the cycle over time, it offers value. I struggle to see what's going to move it off current levels over the short to medium term, unless you see a nice buildup in inflation, not excessive, but somewhere in that 3-4% range, I think would allow them to price.
I take a point on that. Yeah, it is their ability to price, and if what they can sell for is going one direction because their other costs are always going up. A question coming through around leisure. I was actually digging into it. We're getting a lot more tourists coming through. October was almost a record October month. Roy, where would you be your preferred leisure stock, if at all?
So probably Southern Sun. I like that hotel group. It's predominantly in the Western Cape, everywhere where they are, they're where the tourists want to be. They've got good properties. They've renovated a whole lot of them, and it's not trading at an excessive multiple. So I think as the rand strengthens, we become more attractive. Domestic tourism becomes more attractive. Maybe GDP picks up a little. People travel a little bit more. You should see their occupancies continue to increase. That's probably where I would be.
Yeah,
from a leisure perspective.
And in their announcement, there's an update of last month. They were the ones who spoke around best occupancies ever, even exceeding 2010 World Cup. Victor, for you, a leisure stock?
I like Sun International. Still owners of some of the marquee leisure properties in South Africa, from Sun City to the casinos. Although casinos are coming under pressure from sports betting. Unfortunately, Sun International does have a sports betting business, and it should benefit from the growth in that part of the market. It's trading at a P of 5 times, so it looks attractive at these levels. Yeah,
there are some very low PEs lurking around there. Question coming around Bidcorp. I appreciate currency might have some impact. The stock has gone nowhere for years. Is there opportunity in Bidcorp? Victor, for you, Bidcorp, the stock has done almost nothing in the last couple of years. Would you be looking at it at current levels?
Yes, I think similar to the retail detractors at the moment, it is experiencing very low food price inflation. So that's pulling back the top line growth. However, it's managed to eke out just above mid-single digits revenue and profit growth in hard currencies. It might be a little challenge in the UK, but that margin improvement story has played out. Management has executed well there. While it is struggling a little bit in Australasia, there is recovery potential over the medium term, as well as in China, where they have been impacted negatively. But the rest of Europe and South Africa, the business continues to perform well, and definitely I think this is a strong management team. So at these levels, I think it's attractive.
Roy, for you, Bidcorp?
I like this business, but there's two things you have to consider. First, it's a global business, so international investors will rate it relative to the other comparables like Cisco and all of those, which are staples, basically consumer staples, and those have derated significantly over the past couple of years, as investors have taken money out of there into the Mag 7 and all the exciting growth stuff. Then the second thing is the primary investor would be the South Africans, and The problem with the stronger rand is it just takes away from earnings growth as translated into rand. So you put those two together, that means that both categories of investors have basically ignored the business and it's sold off. But in reality, this is one of those long-term compounders, earns well above its cost of capital, has solid margins, and fits into that profile of out-of-home eating, which is where developed economies are all going towards. Less retail, more out-of-home eating through the cycle. So, no, it's one that I like, and especially at prices like you can get right now.
Yeah, but I take your point. Two things working against it, neither of its own control, but that's how markets are sometimes. A question coming through around Naspers. Stocks off some 20%. I like the China story. Surely Naspers is looking good at these levels. Roy, Naspers, what, 1,050 Rand, down from the highs of just around when they did the share split. Is Naspers looking good to you?
So the thing about Naspers is, so it's all about Tencent. And we like Tencent, and Tencent is in the AI game and the Chinese consumer and everything. But remember, there's that dynamic around the various buybacks around, which are providing some very solid support to both Naspers and Prosus, because you knew billions of dollars were going into buying back shares so as to close those discounts. Now that buyback has basically slowed down, so it makes you feel that there's no marginal buy of size here, and you don't have anything that's really game-changing, that's imminent over the short to medium term. And I think that's why it's probably sold off. But I like the stock. I like the Tencent story. I think over time you will earn returns ahead of your cost of capital, and that management team will deliver. But for now, Naspers and Prosus is all about the discounts and how far they've gone, and if there's a buyback.
Victor, we've got about a minute before we go to stock picks. Your thoughts on Naspers?
Yeah, I think still an attractive business. Tencent is executing really well on its AI strategy. We see the tremendous growth in its advertising business as a result of deploying AI in its ad tech. Its gaming business is now firing once again, both domestically as well as internationally. And the only business that's been impacted by the AI constraints on importing GPUs into China has been its cloud business. However, we've seen a couple of interesting developments on the cloud, on the chip front in China. This new NVIDIA of China More Threads listing last week, run by the former executives at NVIDIA. And we see that Baidu plans to spin off its own chip business. So that will be positive for making available high-performance GPUs in the Chinese markets, which will benefit Tencent and its cloud business. I think there's tremendous potential in its cloud business. It's the number 3 player in China at the moment. And as soon as it gets access to more GPUs, that business should grow healthily.
Yeah, we always forget that Tencent is just so much. It's WeChat, but it's a ton else. Let's get to stock picks. Cava Group, I have friends who absolutely say it's the best food you can buy if you're in the US. Victor, this is your pick today.
Yeah, that's my pick today. A friend also told me that they have a colleague who used to love Chipotle. That was about 5 minutes drive away. But the nearest Cava was about 25 minutes drive away, and they drive past the Chipotle to go get the Cava. So a young restaurant, fast casual restaurant chain in the US. It dominates in its category of Mediterranean cuisine, which is said to be the most frequently recommended diet by dietitians. So it has a small base. They have a goal of reaching about 1,000 restaurants in the early 2030s from 300 now. So a long growth runway ahead of it. Good food, good cuisine. It's adopted the Chipotle assembly model in its restaurant. It earns industry leading, or at least equivalent to Chipotle restaurant level operating margins. So profitability is good. The growth runway is strong. Management is well aligned with shareholders. So the stock has been down significantly since the IPO. So I think this is an attractive one.
Yeah, agreed on that. Roy, Premier Foods, this has been another one of the huge success stories over the last year and a half.
Yeah, look, I think there's still more to come. I mean, they've just finished their big super bakery in Gauteng.
Yeah.
They're still at the lowest in terms of costs. You still have low cost inflation for their raw materials. And then they've got that bid that they made for Rhodes Food Group, which allows them to diversify a little bit more, take out costs from the combined group. I still think that over the next 3 years, you'll see that compound 20% earnings growth, solid management team, very concerned, very tight on their costs, solid returns, good cash generation, really no holes in that story. I think for a local business, this is probably going to be your next big food manufacturer domestically.
Yeah, it is, and a top management team there, absolutely. But that's all for Stockwatch today. Thanks to our guests, Victor Seanie from Benguela Global Fund Managers, Mutooni, Sanlam Investments. Up next to close, stay watching.